Hello and thank you for clicking this video. My name is Mina Babawi and I'm the Director of Yellow Brick Road, Stafford. We're a boutique mortgage and finance business and have been operating for over 7 years. However, with over 15 years experience in accounting and banking, and we specialise in NDIS finance. This is such a fairly new area of lending that there are not many banks in this space at the moment. So it's vital that you work with a professional to do the upfront research before any application is submitted. Where we're seeing most people go wrong is they're either submitting an application with a bank either as a residential or commercial lender and treating these as normal applications. They just aren't. Now, there are two ways you can do these type of applications or deals, and the first one is through a commercial option, and the second one is through a residential option. I quite often get asked which one is the right one for me. Now that really does depend. If you're wanting to use more of the bank's money and you're wanting a better serviceability position, then I would say go commercial. If you've got additional cash like deposit or equity to put towards the purchase and serviceability isn't an issue for you, then I'd say go down the residential option, because it's going to be cheaper and there'll be a lot less complexity. So let's talk about the commercial option. So the commercial option, which is what we can do differently, is that we're able to choose the valuer so that, who we consult with on the lenders panel, who's got the SDA experience and who can go out to value the property. And they've got experience and exposure to previous valuations, so they know how it's done. Now, the beauty of a commercial valuation is they look at it as a commercial income stream, and then they apply a vacancy rate and a cap rate. So what we're seeing is the commercial valuations are coming in a lot higher, and it's supporting the contract price. The lender will then lend up to a maximum at the moment of 80% of that commercial valuation. The second thing with a commercial loan is serviceability. So most lenders that we see will take 13-14% of the gross rental income. So it also might help you with those higher income yields to maximize, in a positive way, your serviceability position. Now with commercial, the variable rates are in, at the moment, the mid 5s and 6s, so you can see that the P&I and interest only rates are generally a bit high. Now if you're choosing to go down a residential option, then we don't have any choice on the valuer that we can choose, and the value is usually compared to properties just in a normal house and land package if you're building. So generally what we're finding is the properties can come back short. Now the lenders that we do use participate in the resi space go to a maximum of 80%. So we're basically not taking on any LMI. So you can't lend above 80% at the moment in this space, but there are options of going up to 90% with risk premiums and the like. So you'll see that the serviceability is significantly lower under this option, and they usually won't take any more than 6% of the rental yield into the calculator, regardless of what you're renting it at. Now, quite often I get asked, well, once the property is finished, can we reevaluate it and use it as equity? There's not so much equity after it's completed, and you have to wait quite a few years to build equity in the property before you can lend against it. So 50% would be to 80% would be the maximum for the loan to value ratios. And now we also do have a couple of lenders that will lend on the buyer in an SMSF. So you can't do a house and land construction if you're doing SMSF, but you can use your SMSF to purchase a completed SDA property. So we do have some links that you can find out a little bit more about that option. They are resi, so at the moment the rates have been moving, so we're currently still sitting in the 4s and 5s. And there's a few important points that you want to keep in mind before you proceed forward with an application. Usually these applications are full docs, so they require you to earn an income outside the NDIS yields, so you can include income through your PAYG, or if you earn income as a self-employed person. However, we need to prove to the lender, so you do have to provide pay slips or tax returns, etc. It's important that we can show that you can service your existing debts with your existing income sources and not using the NDIS in any way to support that capacity of your liabilities. So you need to have those other income sources. Now, in terms of the second point, the important point is that you need about, on average, $200,000 in savings or equity to proceed with the purchase for an NDIS. You can fund it through equity, like we're saying. So if you feel that you can make those points work and you fit that eligibility, the next step is to talk about your borrowing capacity. So we do lending capacities for clients complimentary to know where they sit about before buying or going down the road of investing in one of these SDA properties. We'd be able to help you, so I thank you for listening and hope you've enjoyed the video and encourage you to reach out. Talk soon.